I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our Following the Money podcast. Today I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. Today is Sunday, April 2nd, 2023. Let's follow the money. Number one, let's talk about trend and tactical signals. Our Asbury 6 and correction protection model, sometimes known as CPM, have both turned positive or risk on as of the end of last week. The Asbury 6 actually shifted to positive on March the 29th, and the S&P 500 has risen by 2% since then over the next 2 days. Bigger picture, last week's recovery from major support at S&P 500 3,900, which the index had been testing throughout the month of March, targets at least an additional 3.4% rise to 4250. Seasonality in the S&P 500 is typically strong from the end of March through April. So we've got another month of particularly strong seasonality that we believe at Asbury Research is going to be a tailwind for the market this month. In terms of sectors, our SEAF model, which is an acronym for Sector ETF Asset Flows, has ranked technology as being one of the top 3 in our ranking system for SEAF that is based on asset flows that are moving around the 11 sector spiders. It's been ranked 3 or better in 9 of the past 10 weeks since January the 30th, and XLK, which is the Spider Technology ETF, has outperformed the S&P by 10.2% since then. It continues to be favored heading into this week. The other sector that we have been involved in, per our signal from the SEAF model, is communication services. That's been favored by SEAF since March 22nd and has risen by 4.6% since then. Cross-asset, our CARP model. CARP stands for Cross-Asset Relative Performance. That has favored growth over value since January the 26th, so over 2 months, and growth has outperformed value by 10.7% since then. CARP has also favored high beta stocks over low volatility stocks since January the 9th, and high beta stocks have risen by 10.2% since then. Looking across the globe at international, our US versus the world model, which tracks relative performance of the S&P 500 versus 24 foreign equity markets, currently showing just 5 of the 24 that are tracked by the model are outperforming the S&P 500 on a strategic quarterly basis. 4 of those are from Western Europe. 3 weeks ago, 12 countries were outperforming the U.S., half of the countries that are represented in our model. So it looks to us that global expectations for a sustainable U.S. recovery in the United States is what we're seeing in that model. There's more outperformance coming from the U.S. and less from other countries. Finally, just again, keep an eye on Western Europe. There are 4 strong trends coming out of Western Europe, strategic trends of outperformance versus the S&P. All of those trends are being tested. If those trends start to fail, it will indirectly indicate more money moving back into the U.S. All of these factors collectively suggest market expectations of an emerging major uptrend in the U.S. stock market after the S&P 500 broke major overhead resistance back at the end of January. Thanks for listening. If you like our Follow the Money podcast, please go to the contact tab at asburyresearch.com to request more information about our premium services for professional and private investors. You could also visit the Asbury Research channel on YouTube and subscribe to free reports just like this one. Thanks for listening, and we'll see you at the next one.